All right, ladies and gentlemen, unlike yesterday, I am not putting the wrong time in. I am not being late. And we got Roy, we got Tevis. What's going on, guys?
Good to be here. How you doing, Steve?
You know, yet to be determined. Tevis, you doing all right? You rested? You good? Get a good night's sleep?
I'm doing okay. Why? What happened, Steve?
Oh, I don't know. Well, before we go any further.
Oh, you called me this morning? Is that what you're talking about?
Before we go any further, please take a moment and read the disclaimer. We are not financial advisors. We have no idea what we are talking about. Take everything we say with a grain of salt. This is for entertainment and educational purposes only. Do your own due diligence. Make your own decisions.
Absolutely.
Why are you looking at me like that, Tevis?
I don't know, man.
Okay.
You called me this morning at like 8:30 in the morning.
Yeah. I figured you'd be up.
So, all right. We're going to talk today, guys, some NVIDIA. NVIDIA, of course, had earnings, interesting reactions. We might get into the Citrini report. Did you see the AI doom cycle Citrini report? Or
Yep.
Okay, yeah. It went viral. So we might talk a little bit about that as well. And, of course, we're going to talk some SoFi, too. Steve, you're the driver right here. Which of those do you want to start with? NVIDIA or SoFi?
I mean, look, I think we're probably going to spend a lot of time on NVIDIA. So let's just get NVIDIA out of the way and let's see how much time we have left, because that's going to be at least 15, 20 minutes, I think.
Yeah. All right. Do we want to start then with earnings specifically, what they put up, the reaction, or the Jensen comments specifically, that clip, Tevis? Earnings itself, or
what did you guys think of earnings? Tevis, let's start with you. Where are you on earnings?
I thought they were great, man. I thought their guidance was very strong. I thought their numbers were terrific as always. The commentary that Jensen had was interesting, especially on the SaaS components, also on hyperscalers. I mean, stock continues to be disrespected. What are you going to do?
Did you start a position?
No. I closed my position before earnings, which is thankful I did.
Okay. Roy, what did you think of earnings?
Yeah, they were fantastic. Guidance in particular was really good. Even margin looked well. Data center revenue, very, very nice. Good commentary across the board. GTC, of course, coming up relatively soon. Very good. And then the reaction, I would say we sold off a little more than I expected, but going in on earnings, I saw pretty much this playing out. And the reason why is we have the twin contrary arguments that are out there regarding AI being like the AI doom cycle, where AI is going to eat every single business out there and leave us all unemployed. And the other is, no, AI CapEx is a bubble and it's going to drop off a cliff soon. And I was like, okay, if NVIDIA does too well, it feeds one of these. And if they miss or don't do as well as people are hoping and expected, it feeds the other. So I'm like, okay, Jensen's already said everything he's going to say. NVIDIA has already killed it time and time again. We've already seen what's happening in this space, even prior to NVIDIA earnings. So I was like, yeah, the market's probably going to sell it off a little bit. The market will be weak for a little while. I don't know how long it'll take to dispel this, but yeah, no like huge surprises there. Just really good earnings. It's easy to buy right here.
Yeah, I mean, this is hands down the greatest quarter from a business I've ever seen. That is every business I cover, every earnings call I've read, just everything I've looked at. This is the greatest quarter I've ever seen. And when you look at what they put up on a quarterly basis in Q2 2024, their year-over-year growth rate was 122%. And it decelerated, rightfully so, for the next 4 quarters down to 55.6%. And then in Q3 of this year, we got reacceleration to 62.5%. And then in Q4, it increased by 10.72% and reaccelerated for the second quarter to 73.21%. And now their guidance on 78 billion in revenue is additional reacceleration to 77% year-over-year growth. And in Q2, if they put up 83.5, it's a continuation of reacceleration. It's just the most fantastic quarter. The margins are insane. This company is being so disrespected that it looks like the market wants to take it down to where Micron was trading in single-digit PEs at this point. That's what it feels like. The doom and gloom couldn't be any further from the truth. This is the reality. This is what their profitability and revenue looks like on a quarterly basis. And the hyperscalers are not slowing down on CapEx spend. That's the reality. That report, and it's scary that the market can sell off so hard on a report about what may or may not happen in 2028 that you can't prove or disprove. That's the market we're in, and that is outright scary that companies that are putting up fantastic earnings, fantastic growth with numbers that don't make any sense are being penalized. It's insane.
Yeah, and it can last for a while too, but it's kind of the phenomenon, and there's a pairing of these that if a stock has gotten sold off, and then more bad news comes and it doesn't move the stock price, usually that's an opportunity to the upside. There's a point where it's just all the sellers are gone and exhausted. It works in reverse as well, although it's not quite as extreme, when you have a company that has fantastic news and yet the stock doesn't move. And we've seen it. Somebody was joking prior to earnings that NVIDIA is a stable coin now. And it has traded very much in a range for 6 months, and it can do it for longer as well. But yeah, that's just kind of where we're at. Tevis, any thoughts on what Steve shared there? And then we'll talk about what we think might, what it might take to actually break out of this.
Yeah, I mean, if it's a fantastic company, I don't think anybody is throwing into contention the actual execution ability of NVIDIA as a company, or the fundamentals, or the fact that it's cheap. I think everybody acknowledges that it's cheap. I just think that we're in a phase of the market where they just don't care. And unfortunately, there's many cheap Mag 7 names relative to where they should be trading.
I mean, have we ever seen it this cheap, though, on a forward basis? Microsoft, Amazon,
Incredible.
Meta, NVIDIA, under 18 times forward. I mean, that's insanity. I mean, NVIDIA is now under 14 times 2028 earnings. It's under 17 times next year earnings. At this rate, it's going to be under 20 times this year earnings in like a week.
Yeah.
And even if you don't, even if you discount the forward, growth out the window completely, and if you just look at the current PE level, 21 PE is cheaper than the rest of the market average.
Yeah, market's trading at 29 times.
Yeah, throw this up real quick. We can see it kind of charted out. So this blue line is the actual price to earnings. It has traded at a cheaper price to earnings in the past, but briefly. And this green line is the forward price to earnings. This is just 1 year forward. There might be better ways to evaluate this company, but what we've seen, let me remove the price to earnings here, and you can actually see this a little bit more clearly. There is, other than rare exceptions, so going back to 2016, and I have no idea what the company was like, you can see, you don't do technical analysis on a chart like this, but you can see a lot of buyers tend to step in about the 20 forward price to earnings mark. This, by the way, was not because anything that happened as far as a company price, but just when they began putting out those ridiculous quarters and the price to earnings collapsed, even as the share price went up. And people just didn't, it took them a while to actually believe it. But here we are, trading at just above that 20 mark. So there is a point, where it will continue execution, no more weird, crazy stuff that's in the narrative, where buyers again will step in and be like, okay, yeah, there might be questions that we have, concerns that we have, things that we're not certain. But one thing that is pretty certain is buyers have been in there in the past and they will be there in the future again around that range as well. I don't think anything is going to change and shift that. Could I be absolutely wrong and surprised on the downside? Sure. But NVIDIA is a quality company, and I don't mind adding more of it here. So, yeah, it's one of those that, like, it's actually kind of astonishing just how long it's been in the range. And if you look at, like you had right there, Steve, Costco thrown up, you can add Walmart, you can add a lot of other names that are trading at much higher multiples for price to earnings. Why is that? Is that just so much AI fear that they're like, well, at least Caterpillar and Walmart and Costco are not going to get destroyed by AI?
So I don't get mad at Caterpillar. I think that's a great example because look, Caterpillar is going to expand profitability because they are a critical component of the build out phase. So I can't get mad at Caterpillar. But when you have, and I don't want to rehash the discussion, so I'll just say one sentence on it, but when you have Walmart and Costco trading where they are and Amazon trading where it is, that's an oxymoron right there. It makes no sense.
Yeah. So what do you guys think then is going to take us to move outside of this? Mine is just, I think it takes time. It could take another quarter or two, but we'll start with you, Steve. What do you think it takes for us to move out of this range with NVIDIA and thus the market, and then you, Tevis, after that?
Unfortunately, I think it's going to be a combination of rates getting lower, the business environment getting better, all this stuff in the Middle East settling out, they're not being scared about oil going from where it is right now around 67.50 to 80 or 90 or even over 100 because of fears that we're going to strike Iran. And I think we need another quarter of solid earnings. And I hate saying that because the unfortunate part is we are in a market where news from anybody or a thought from anybody can move the market structurally. And we've never really seen it to this degree before. And people are disregarding facts. The facts are the hyperscalers are not stopping. The facts are they have the cash flow and the balance sheets to spend what they want to spend. The fact, which is half an opinion, but I would like to say 100% fact, is the CEOs of these companies know their businesses better than anybody else, and they see the ongoing demand for their products, and they are making decisions that are not the best decision for valuations today, but the best decisions to drive value for shareholders tomorrow and the next month and the next month, next year and next year. We are in a cycle where people are trying to correlate this to the dot-com bubble, which are two different things. They are nowhere near the same. It is getting crazier and crazier with cheaper valuations. And throughout the whole history of humanity, technology and innovation has never stood still. It has always evolved. And to think that this will not continue to evolve, and to think that these companies are overdoing it, or that the fears that the compute isn't needed, who are these people writing these research reports to decide that? They're not controlling these balance sheets. They're not controlling these spends. It is absolutely ridiculous. And the whole SaaS thing is even stupider because the other reality is companies are not leaving, and you have Jensen coming out and saying that agents are more likely to work with these platforms and on these platforms than replacing them. People are not vibe coding an enterprise software platform. And I think this is just a blip in a wheel. We've seen SaaS destruction before in the past. We've seen these companies get to the point where people get worried and you see a rotation. But I got to tell you, it looks like staples that have minimal to no growth are trading like growth companies, and the ones that are actually scaling are the value companies now. And I think that's an opportunity. Regardless if it takes a month or a year, it doesn't matter. There's a lot of opportunities right now.
That's the beautiful thing about being a long-term investor and not being in leverage. You can just buy and hold if you don't have a short time span that you have to get the money at. And if you invest in quality, like over time, it's hard to predict short term, but over time, we tend to be rewarded in those opportunities. Tevis, what do you think moves it first NVIDIA out of this range? Is there a catalyst that you're looking for, something specific from the company, something specific for the macro, and then for the broader indices as well?
I think the thing that people have to keep in mind is that in 2025, NVIDIA doubled. You know, it went from the tariff liberation day drop to by the end of August or by middle of August, it had doubled from there. So it's already done a big move up. And I think there's recency bias because it's been flat now for 3 months, 4 months. But the moves that it makes are very much a big, aggressive move. And I think we need to allow time for the market to be convinced that the CapEx spend in AI is going to translate to higher margins, higher revenues, higher productivity, faster growth across the board. And I think that is going to become more apparent towards the back half of this year as more companies report earnings and probably towards next year. But at the same time, NVIDIA might chop sideways for, maybe another couple of weeks, maybe another couple of months. But if you know one thing for sure for NVIDIA, like when it does make a move, it makes a very aggressive move. So I wouldn't be surprised if, we chop between 165 to 200 and then it just jumps to 250 without any, rhyme or reason on the back of another earnings or on the back of some other macro news. Because the market, it just feels as though is in somewhat of a rotation right now. And it's kind of irrational for it to be, but we just have to wait for that money to rotate back. And it's not just an NVIDIA problem. It's across the board.
Yeah. Yeah, lots of names are in that, and lots of opportunities across the market too. Let's pivot just a little bit, not fully away from NVIDIA, but Tevis, you have that clip, Jensen Huang talking about specifically what's happening in the space and dispelling some of those concerns, macro concerns that others have around AI. It was really good thoughts. And if you haven't seen it, Steve, I've seen it once. I've intentionally not seen it since then, just because it'd be a good thing for us to react to.
So the thing is, this is a 5-minute clip. But we'll play it and then maybe I'll put it on 125x. And
that sounds good. Yeah. Make it a 3-minute clip. Not quite, but.
Can you throw this up, Steve?
And that they've been calling it. You look at law firms, cybersecurity firms last week, and then IBM shares this week had their biggest drop in a quarter century. Is that overdone by the markets, or do you think there's a real good reason that investors are looking at this and saying, this is going to change everything for these industries that have been so entrenched?
Deeply, I think there's a deep misunderstanding. What Claude is definitely revolutionary, and it's an inflection point for AI. It's the first time that AI can perceive, it can reason, but it can also do work. It actually performs tasks. Like, for example, it can write software. It could create a website for you. It could arrange a vacation for you. And so it can actually perform tasks. And that's the reason why we call them agents. They're agentic in their nature. What software companies, the reason why it's so exciting, of course, is because it can write software. What's going to happen are the tools companies, the platform, the ISVs, the SaaS companies, the tools companies, they will use agentic systems to develop their software. But enterprises are not going to go develop software. They're going to use agents to use those tools. And so what's likely going to happen is that agents won't replace the tools, but agents will use tools. That's the reason why we also say agents are tool users. Why write rewrite the browser when the browser exists and just use it? Why rewrite Excel when Excel exists, just use it? And so all of these tools that we use today, whether it's Cadence or Synopsys or ServiceNow or SAP, these tools exist for a fundamentally good reason. And AIs, these agentic AIs will be intelligent software that uses these tools on our behalf and help us be more productive. And so what's likely to happen, and this is very counterintuitive, it's very likely that because we have so many agents in our company now, the tool use will actually go up. And so, and you could see it all over the place. The number of C compilers that we use, the number of Python programmers the Python programs that we have, the number of instances are growing very, very fast because the number of agents we have that use these tools are going up. And so I have 42,000 biological employees, and I'm going to have hundreds of thousands of digital employees, and together we're going to use a lot more tools.
But that means that you think that they're not going to disintermediate these companies like a Salesforce or so many of the others along the way. You think they'll still be using those tools coming from those companies that are being sold off right now by the markets?
I think so. I think the market's got it wrong. I think it's very likely that these companies that we're talking about are going to introduce agents that run on their platforms. You know, these agents, of course, they have to be experts in what they do, and nobody's going to understand customer service better than ServiceNow, and they're going to come up with agents that are really fine-tuned and optimized for the type of work that uses the tools that they have. In the end, also, we need the tools to finish their work and put the information back in a way that we can understand, and that we call them system of records. And so each one of these tools have their own system of records. Those system of records exist because we put them there and we use it so that we understand the information that's finally complete. And so those system of records will still be ground truth, and they'll continue to be ground truth. And now the agents will, help. They will use it, and they will populate the system of records. They will use the tools that are available on these platforms. I think a thought experiment that could be helpful is, imagine one of these days when we have robots and these robots are in our homes. It's very unlikely that the robot will come up with a new Cuisinart. The robot will just read the manual for the Cuisinart and just use the Cuisinart. It's more likely that instead of coming up with another way of doing microwaving, that the robot will just use the microwave. These tools exist for a good reason. And so I'm fairly certain future robots will use screwdrivers and wrenches and pliers and things like that. And these tools are essentially in their digital form from the companies that you're talking about.
So they're not going to replace the tools. They're just going to replace us, the humans that use all these tools to begin with. That's an interesting thought experiment. I like it.
Help us.
They're going to help us. Okay, we'll take that.
They're going to help us. Yeah, they're going to help us. And the reason for that is because, as it turns out, that for most of our software engineers, coding is what they do. Just as for a CEO, typing is what I do. But the purpose of the typing, the purpose of the coding is solving problems, and solving problems that we haven't even thought of solving. That's called innovation. And so the purpose of the work won't change. And so we're going to need lots and lots of software engineers. But maybe they just don't have to code like they used to code. They'll code in a new way. They'll code in they'll describe to the agents what their intentions are, what kind of ideas they have, and the agents will write the actual software. And so, we'll work at a different level of abstraction. We'll be a lot more productive. Hopefully, create a lot of new things and solve a lot of new problems.
Couldn't agree more.
I love at the very end he was quick to correct her. AI is just going to replace us. It's like it's going to help us. That's the goal. We'll see how displacing AI actually is, despite what Jack, CEO of Block, and others might indicate. We're a long ways away from that even becoming a possibility. But thoughts on that, Tevis first, and then
yeah,
Steve.
I mean, there's a couple of really key points that I think people should understand there. The first is that SaaS is dead / AI cannibalization argument, where he's basically saying, no, this is going to actually lead to more usage on SaaS, because all of a sudden, like with a Cuisinart example, he was saying like, hey, you have these existing tools on the software basis. You have this APIs, you have the infrastructure already laid out. Like these agents are just going to use that infrastructure instead of trying to rebuild everything from the ground up, because it's like there's no utility in that. And so having this world in which AI is a multiplying factor looks very different from a SaaS perspective than this perception the market has currently of AI being a cannibalizing factor. And I think that there's also something to be said. I mean, we were talking about this last week. There's something to be said about the SaaS companies themselves leveraging agents to amplify their product offering value proposition.
Steve?
I think Jensen hit the nail on the head. I mean, I don't believe that these software companies are going to be cannibalized. I believe that they're going to be able to upsell their own agents to make workforces more efficient. And the seat loss that they experience, they will be able to offset that through agents and other types of things they can upcharge for. I mean, what happens when companies lay people off, have less expenses, but are generating more revenue? They can afford to offset the loss of human help with adding help from the software side. And that's unfortunately probably what's going to happen. And there is a bigger philosophical thing that we have to discuss, not on this, but at some point, they need to figure out what they're going to do, because the reality is Block getting rid of 4,000 or 5,000 people is only the tip of the iceberg. These companies are going to shred back office. I have personally seen it happen when the big cloud movement happened. I have personally seen it happen. And my prediction is this is going to be another reiteration of it. You have platforms like Workday, platforms like PeopleSoft, platforms like SAP that over the past 10 years has shrunk financial or fiscal departments, however you want to say it. Every company says it differently. When you think about what AI is going to do and what workers are going to be able to do with it, you have to think that these companies like JP Morgan, that has 360,000 employees, a PayPal that's got 24,000 employees, that just saw what Block did. If you don't think PayPal is going to do it with a new CEO that put cuts at the top of the list when he was at HP, I don't know what you're looking at, but they're going to look at what their most repeatable processes are and figure out how to automate them. And unfortunately, it's going to be a really scary time over the next 5 to 10 years, maybe even the next 3 to 5 years.
Yeah, I think it's further out from being significant disruption. I do think what's going to happen is what Sam Altman calls AI washing, which is companies like Block blaming AI and using that as a handy scapegoat. This happens, by the way, not just with AI.
Roy, let me ask you this. Let's say more companies throughout the year do the same thing. Will you retract that?
If it's actually because of AI, yeah. But at least in the case of Block, like, dude, it's bloated. Like, same with PayPal. PayPal has been bloated. It has been bloated for a long time. It's been corrected some under Alex Christ, but not enough. It's more of a cut just because, like, some of the departments and things that they've done are duplications of others. So that doesn't make any sense. And then B, they just overhired dramatically, especially in COVID. It was the same thing with Jack Dorsey and Block. Like, talk to if you know anybody that works at Block, talk to them, and they're going to say, no, this is really not because of AI. They are using it internally. They talk about Goose all the time, but that's made them more productive. It's not outside. I mean, like, honestly, there are some jobs that are being removed because of AI, but I don't even think that's 10% of the story there that's happening with Block. It's just Jack saying, okay, I'm going to save face by blaming AI and saying we're going to be an AI company.
The problem with that is that it's so non-deterministic because it's unique from one company to another, the degree to which AI impacts their productivity. Because there's the actual tool usage or agentic use cases, and then there's like the opportunity cost. And I think it's just fundamentally, when they're saying AI is replacing it, what they're really saying is we have too many humans for the actual seats in our company that we need, or for the tools we need. And that's exactly the same thing as what they've been saying when they do layoffs. Hey, we're doing a reduction in force to streamline performance and actually be more lean and grow faster. It's just this time when they blame it on AI, it's a macro catalyst. And when they do it themselves, it's like, well, why'd you guys overhire in the first place? Why are you guys doing that? And so it's a way to deflect blame, but the core is exactly the same in terms of what they're saying. They're saying we're letting people go as a result of AI, meaning AI can now do what it used to take people to do, and we can save money that way.
I think that the bigger worry, and this is not to rehash like the old arguments, is when robotics is breaking into the workforce meaningfully. That's when I'm very concerned about the workforce. This right now, no. There is a bit of truth to AI disrupting jobs and certain spaces, like entry level coders. Sorry guys, that's rough. Used to be a almost guaranteed beautiful job market, lots of demand, lots of salary, and now it's hard. So I'm really thankful my oldest son didn't go that route. He was thinking of it right after high school. So
Yeah, but there's still a lot of data entry jobs that, with OCR technology combined with AI, those are going to get displaced. There's a lot of back office services jobs. I mean, think about it. You have a big consulting firm like Deloitte. I mean, you're telling me they're not going to be able to benefit from this? Or vice versa, is a company going to need to spend all that capital on $500 to $1,000 an hour consultants in 3 to 5 years? Baker Tilly. I don't know. I would think that a lot of people are going to be able to harness AI and not need to pay for consultants in a lot of cases. And then with what Roy said, when you add robotics into it and you combine AI with robotics, it's game over for a lot of things.
which doesn't mean people are going to starve or anything. The nice thing is we have time to kind of figure things out, and that's the one silver lining of this happening right now, which is like way too early for it to be a meaningful impact. It will impact individuals, but like on a macro level, not a large amount of people. But we can kind of start thinking through of like, okay, if this distressful wave does prove out in like 4 or 5 years as robotics enters the fray, what can we do? And I hope there's a better solution than UBI. Like people will not be starving in the streets, but yeah, we got to figure those things out. I don't have a great answer, but yeah, the nice thing is like the current twin arguments are just so overblown. The amount of disruption I think is overblown, and you'll have opportunistic companies that take advantage of and just say, oh, it's because of AI that we overhired back in 2020, and we're not going to talk about that, but we can make cuts now because of AI, even if it's disingenuous.
The real question is, what companies look the most interesting that have gotten beaten up for this sector? Because look, AI is not going away. And that's something that these people are getting wrong, that continuously are bashing this. I think all these people just missed out and they're pissed that they missed out and they continuously are being proven wrong. I mean, look at what Burry's doing right now. Sure, he was right that Palantir topped, but a lot of people were saying Palantir was overvalued. That's not something that was that hard to spot, the same way it was very hard to spot the financial crisis. But these people are so angry about technology. Where are the biggest deals?
Yeah, of stocks that I don't own, Micron looks it's trading at a ridiculous valuation on a forward PE standpoint. I think it's like 12. And you look at what they're growing at, and the need and demand is there. Now, the forward projections a couple years out, that's I think harder to predict, and so you can say, well, analysts have put out too much there. I don't own any of it. I don't really have any free money right now, but of companies that I actually own, I mean, like NVIDIA is the easy answer, of course. We've already talked about it, but yeah. What about for you, Steve, and then Tevis? What is there a company or space in this that's been disrupted enough as far as a price that you're like, hey, these guys will be fine. I should be adding.
So it's all companies I own. I don't have any new ideas. I own a lot of different companies. NVIDIA, if I did not have the position I have, I would add to it. I am adding to Amazon. I think Amazon's going to be one of, if not the largest beneficiary of AI going forward. I am probably going to start adding to Salesforce again because I think that people got the quarter wrong. I'm going to do a piece on it this week. And today, I did add to Zeta. And I think that the quarter was incredible. I think people that are not looking at this company and not looking at the quarter and what they are going to do in the future are missing an opportunity. Their CEO just said they will be doing 10 billion in revenue by 2030. I mean, it's so undervalued if you think about where they're going in the future and you really look at what he said in some of these additional interviews he's been doing and you look through the quarter. I mean, there's a reason I'm buying. The numbers, they're flipping profitability. They're in a really good position. I mean, I think they're sandbagging numbers right now on the top line. They're servicing 51% of the Fortune 500, Fortune 100 companies, and their net dollar retention was 128%. It's incredible. And they're actively saying they are eating the trade desk lunch and they're taking customers away from them.
Yeah, the trade desk also reported, and yeah, it looked pretty bad. I do like Jeff Green. Yeah, I've not bought Zeta. Like the hardest thing with Zeta right now for me, Steve, is there's so many opportunities on the market. So I like a concentrated portfolio, so I'm not buying Zeta.
I get that. And just think about it this way. At a 4.5 billion market cap or 4.25 billion market cap, what actually needs to happen for them to go to a 10 billion market cap? When you think about a lot of other companies that have gone to 10 billion or further, generating less revenue and no profitability or no revenue. It's just, when I think about what has the potential to 1, 2, 3, 4x over the next 5 years, it's not NVIDIA. I don't think NVIDIA is a 5x from here in the next 5 years, but I think Zeta very easily could 5x.
Yeah,
I mean, that 5x puts them at 20 billion market cap. Like they're a small company.
I don't know many that are thinking NVIDIA could 5x. Like it could happen, but that's not even the bull scenario. So,
Right.
Tevis, what about for you in AI specifically of distressed names or software? Is Figma the one that you're really like eyeing and saying, "Hey, this is silly. I want to buy and add more," or is it another name where you're really looking close and or a buyer?
I mean, I think similar to you, Roy, I don't want to spread myself out too thin. And like, yeah, I get the idea with Zeta and like, oh, like what is their potential to double or whatever. But like, if I start a position, it's going to be a small position, not because I'm not bullish, but because I'm just not that flush with, if I don't sell something, it's going to take time for me to build something from the ground up. Okay. What that does in the building phase is it just gives me one extra thing to think about, to follow, to track. And so as a result, I'm like, well, there's things that I still haven't built out in my portfolio. And there's a shape that I wanted to take, which I'm still far away from. And all of these other things are distractions. Yes, I would love to have a position in Figma, or at least read more about it. Wix, for Manuel, it was looking interesting. There's plenty of things that I'm interested in, but it's like, dude, like I still don't have an NVIDIA position built out. I still don't have a fully, like I don't have a full Amazon position that I'm happy with. And so it's just like there's these things where I need to secure the foundation first of the portfolio before I can start diversifying into other names in order to feel comfortable and not spread too thin. And right now, it's just like I feel very comfortable in my SoFi and my Nebius positions, like where I've built them out to. I just need to be able to build out the other ones.
All right. Speaking of SoFi, let's go ahead and pivot there. Steve, well, I guess you may not be aware of this, but SoFi actually fell under the market cap requirement to enter the S&P 500. Now, the caveat is it's the 5 weeks before where you have to meet the minimum requirement. So they do technically meet. However, I've never seen, and I did run it through a couple of LNMs in case I missed something. I've never seen a company be inducted in the S&P 500 that at the time of the announcement was under the market cap requirement. It can be close, technically it can be under if it was still, there 5 weeks before. I've never seen it. So thoughts on, I guess, Tevis first, SoFi. Do you think that they get in the S&P 500 this quarter, and does it matter?
I think it does matter. If they get in, I don't think they're going to be like, severely penalized if they don't, because I think them getting in March is not the base case for most people. They broke under the requirement. I'm sure they can break above next week again, but yeah, I think the chances are very, very low for March.
All right, Steve, thoughts on SoFi and S&P 500 and overall thoughts as well. I know you had some things on X to say.
Yeah, I mean, I have no idea if they're getting it or not. The S&P loves financials. I think it's important. I want to see them in. I have no idea. I mean, I don't even know what other companies are potentially getting in. It's not something I track.
Yeah. Vertiv is a slam dunk, and outside of that, it's all speculative.
Yeah. So it's funny because somebody who doesn't use their real name came at me on X today, and I responded in kind, because if you don't know how to box, don't get in the ring. Like, I don't mince words. I said last night that SoFi was trading at a valuation where the market is classifying it as a bank or a financial institution. It is not trading as a tech company. And that's my opinion. I don't know if that's actually true, but that's what it looks like when it's trading here. Do I think it deserves a bigger multiple? Yes. But my opinion is that it is trading like a bank. And somebody said that they've never seen somebody flip-flop on a company so much. And I came out with probably 800 words today, put together a chart. And look, I've written 33 articles about SoFi, every single one of them bullish. I was bullish when this was $5 and 22, when not many people wanted to talk about or touch it. And am I critical of SoFi? Sometimes. But the reality is that the perception of the type of company they are is being classified as a bank, in my opinion. And when I say that they're trading at a large multiple on tangible book value, I've never said what that number is. So people to say that I'm incorrect, that's not trading at a large, you don't know my definition of a large multiple is. And when you actually look at the numbers, and this was from earlier today, on price to tangible book, out of 18 banks. Now, somebody tried comparing SoFi to Morgan Stanley to try to prove that it's not trading at a big tangible book value. It's like, dude, Morgan Stanley's an investment bank. It is valued differently. Yeah. Now, these are all banks. Large money centers, regional banks, these are all banks. SoFi trades at the second largest price to tangible book and the largest price to earnings. And what I said is, if they are being classified as a bank by the market, then they are being rewarded for their growth rate, because their valuation on the price to earnings is more than double the next bank. And that's a fact. Now, do I want SoFi to be looked at differently? Yes. But I think certain things need to happen, and I spelled them out. And look, these are my opinions. Anybody can disagree with me, that's fine. But don't try to sit there and try to call me out, of all people, that was here in 21, before people even knew what SoFi was, saying I'm flip-flop because I've never sold a share. I've definitely critiqued them several times. But I have strong opinions on what I think they need to be doing. And what I think that they need to be doing is shared by many people. And I think everybody has the common goal that's a shareholder, that they think SoFi has the potential to become a top 10 financial institution and one of the largest financial companies in the market. And for me, for them to be looked at as a unicorn or to be looked at as not just a bank or as a hybrid, they need to monetize the tech platform by powering their competitors and generating large incremental revenue on an annual basis with annualized price escalators. Because then not only are they cutting their own costs by owning the back end, but if they're powering hypothetically a Wells or a Citibank or a USB, and then some regional banks, that's a tremendous amount of revenue that they're going to be generating. And it makes them now not just the bank, but they are also a tech SaaS company.
Yeah, I think the loan platform business really was what shifted them to a hybrid multiple. And we saw really the last bit of the year, especially as they got into their all-time high and fell a little bit from that as well, that they went in a very different direction. Part of it was, actual earnings were ridiculous and amazing. Just even given that price to tangible book value that you show up there, that they do trade at a premium, I think part of it is like they are seen as a hybrid company. The tough thing is in both buckets that they find themselves, neither are doing well right now. So it comes under kind of like a double attack. It's a double-edged sword type of thing. I like with NVIDIA, I think it's just going to take time. And, the stock price was up immensely. Whether to get in the S&P 500 or not this quarter, it's not going to make really a difference long term. It does, and it would form a better floor and add a little bit of stability to the stock, especially if Noto bought to kind of prop up the price around the same time. But we could definitely continue to have some chop for a little while. Your thoughts? Any more thoughts on SoFi, Tevis?
No, we'll see what happens with regards to S&P inclusion. I, again, don't think it's going to happen in March. I wouldn't be surprised if Noto starts buying in March, but it's going to trade in a bucket, right? Like SoFi was down 8% or so today. American Express was down 8% today. Bank of America was down 5% today. Like all the financials got hit today. It's nothing specific to them. Q4 earnings were terrific. I think the roadmap for growth and the guidance is amazing. So it's just one of those things, man. Like nothing has changed.
Yeah. All right. What about for crypto? I see a couple of questions on BMNR and Ethereum as well. I know that you saw it, Tevis, and Steve, I think that you probably did as well. Tom Lee is calling this a mini crypto winter. I think given price action, certainly it is wintry. When do you think that we see this breakout to? I know a lot of crypto names have been caught up in a down pull on prices and activity as well. Some deservedly, some undeservedly as well. Yeah, we can talk. Chris,
we'll be there in a few minutes. I think we need legislation passed. I think it's going to be very grim until it gets passed.
Clarity Act?
Yeah.
Yeah. That'll help for sure. Clarity on the Clarity Act. The market does love certainty, and right now there's just not a lot of it. So I don't know that that'll mark the inflection point. But yeah, Tevis, any thoughts on that beyond what Steve shared?
We're getting right to the edge of that March 1st decision. So the next couple of days are going to be important to determine the pace that we can set for our expectations for clarity. Because once we know what the stablecoin, rewards are going to be, then is that we're hoping to get it signed by April. And I think from a catalyst perspective, clarity is by far the biggest catalyst right now for Ethereum. And yeah.
Yeah, it'll be interesting. And I hope that the clarity stuff gets worked out. I do hope that banks don't win that and force stablecoins to basically, with certain loopholes, not be interest yielding. Although Figure does benefit because their stablecoin is not tied to the yield off of treasuries, but real world assets. So, anything else you guys want to discuss, or is it PayPal time?
PayPal time.
Man, it's been an interesting week for sure. But yeah, what were your thoughts with the buyout rumors, speculation, and where it goes from here?
I mean, rumors are rumors, right? You don't know if anybody's going to do anything. And I don't think people should be making an investment. I certainly don't make investments based on if a company can get acquired or not, because nobody's got inside information about if that's going to happen. But from a numbers aspect, it does not look like it can really go that much lower realistically. Things trading at less than 10 times earnings, for God's sake. They have a buyback yield, depending on if they use any cash on the balance sheet, of up to 17, 18% if they want to take a little bit of cash off. I mean, it's pretty simple math. $6 billion on a $48 billion company, or whatever it's trading at, $40 billion company, that's a big buyback yield. Now, when you're doing the free cash flow that they're doing, and you can manufacture earnings, and this is a company that has never declined on a year-over-year growth rate on revenue. They have levers that they can pull. They'll probably do a reduction in force, a RIF, because they have 24,000 people. They have a new CEO that's incentivized to get the share price higher. And this is a company, I would not be surprised if it gets acquired, but I don't think it needs to get acquired. I think they need the right person steering the ship. And if they eliminate a bunch of expenses, that will boost the margins and boost the EPS. I mean, 24,000 employees for that company seems like a lot, even though I'm not in the business, but it seems like a lot. And the profitability is too large for this to be trading where it is. I mean, they could buy back the entire company in less than 7 years at this point.
As long as it's sustainable, yeah.
Free cash flow certainly looks sustainable with everything that's happened.
It's hard to say. We'll have to see what they actually do with Alex on.
But Roy, is it really hard to say when the consensus community only expects EPS growth out of them?
Yeah,
I'm not talking about us. I'm talking about Wall Street analysts.
Yeah, but they guided for negative. We'll probably sandbagged. I think that they'll probably be okay. Like I do think they're undervalued, and I do think that the buyout rumors are very credible. We heard it both ways.
Hold on. What's the reason that they guided for negative?
It's
the reason.
Kitchen sink, yeah.
What?
Kitchen sink earnings.
Yeah, the 14-cent investment portfolio that was attributed in 2025 that they're not going to have in 2026. And the street is calling for $5.34, which is 0.5% increase. And then next year, $5.82, which is a 9% increase. And that's 41 analysts that are calling for a 9% increase next year.
We'll see. But
man, you hate this company so much.
I don't hate him. No.
You hate this company so much.
No, I'm ready to not talk about them anymore. But on the buyout
this
stuff,
could be one of the best value opportunities right now.
I don't know about that.
I mean, it doesn't look like their free cash flow is stopping. Their free cash flow has been big. I mean, I'm going to bring it up. You look at the cash flow statement. I mean, it is a sin that this company has gotten to where it is. The market has no faith in them. Yet, look at this. Huge. Huge, huge, huge. And guess what? Companies that grow revenue year over year, every year, are not dying companies, regardless of what the total payment volume is, regardless of any of the internal metrics. This signals a company that is still growing. And guess what? They're likely to grow again this year and next year and the year after. So, I don't know. Should this be trading at 8.5 times this year's earnings? Under
No.
8 times next year's earnings? No, it shouldn't.
When has the
By
market
any
cared
means.
about any of that, though, Steve? Like over the past several years, the market hasn't cared about the free cash flow. The market hasn't cared at the fact that they're not dying. The market has cared pretty much about the growth being negligible, and that's it. The sentiment is rock bottom, dude. Like they need the rumors of a buyout to jumpstart the price action again, and that's pretty much all that it'll take. Dude, they partnered with OpenAI, and they fell on that earnings. Like OpenAI has been the steroids of every other company when they report earnings, where they just go up every time they mention OpenAI. For like half of 2025, that was the case, except for PayPal. And so it's just like, I know that it's criminal that they should be trading this low. I know that they're discounted. I know that the free cash flow is great and blah, 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 blah. The market doesn't care, dude.
No, of course. Obviously, the market doesn't care.
The market is always right. Except when it isn't.
Except
But-
when it isn't.
Exactly.
Yeah, I mean, like, the bottom line is, like, is it undervalued? Yes. I don't think that there's many people that can look at it and say with a straight face it's not. Is it an opportunity? Yeah, probably. Are there better opportunities out there? I think there's a lot of better.
Absolutely, there are.
And that's the thing. So the other thing with PayPal too is you don't really have a good look as far as like, is this business just going to be on autopilot? Or they're just going to stay the line with it. Like there's been some talk on this, but it's not been crystal clear yet. And it may actually take some time as well. Under Alex Chris, there was a lot of innovation. It didn't happen as fast as it should have. There were a lot of announcements, but a lot of those announcements ended up not actually making something real credible, or at least not as fast as it should have. So I think they're going to be worse off without Chris at the helm, even if they do cut more. And but the one wild card I think is, I think you have two now actually with the buyouts. One is buyouts happen, multiple bidders, bidding war, and all of a sudden we're looking at PayPal selling in the 70s. Great for shareholders. That's awesome. I think multiple bidders for parts of the company is a reality. We've seen those hits, but for the whole company, I think Stripe is probably it. And then the other is, of course, if they leave the Alex Chris projects in there and like advertising, for instance, actually really takes off, and that's nothing good is priced in. That's a wild card there too. But they're just easier plays. And
So that's the best case scenario, Roy, that you laid out. What news that we got over the past couple of days was that the Stripe news is actually, they're not in talks. Stripe is not interested in buying them, right? And so it could just be that Bloomberg reported something that was not true for whatever reason. And what I mean the first time, it's like when Reuters reported that misinformation about Tesla and Tesla stock fell, or name any other time. Like even last week there was there's a fake article on CoreWeave that dropped Nebius like literally 5 days ago. So it's just like all we have that we're going off of is some rumors and an article that was dispelled the next day. It could just be that this story has already ended and nothing's going to happen. Like the best case scenario is like, okay, we get multiple bidders, bidding war. This thing gets bid up into the 60s, 70s. That's great. Worst case, like in the middle case is like, oh, you have one key bidder and it goes where it goes. Worst case is that one bidder that you have right now is no longer interested, or talks fall through or whatever, and nothing happens. We don't have enough information, I think, to make a determination which way that's going to go.
Yeah. I think the most likely, well, it depends ultimately on the board of directors. If they're like, no, we're way undervalued, we're not selling except for whatever price, it's way too high. And frankly, like anything that's even in the $70 area is too high unless there's multiple bidders. If you have multiple bidders, it's not. But if they're holding out for, like, some shareholders want 125, well, I mean, sure, if I was a shareholder, I'd want 125 too. It's just not going to happen though. But bidding war, maybe. And so if they have a more reasonable valuation that they have in mind, I think Stripe is able to acquire all except for maybe Braintree. Regulators might stand in the way of that. But Braintree is one of two assets that I do think will have multiple bidders that'll bid it up, and the valuation is going to probably be higher with Braintree bid on separately and Stripe acquiring all the rest. We'll have to see. But yeah, I'm not getting back in. Not because I'm jaded or bitter at PayPal or anything like that. And I wish you guys well in it. I just think there's easier and better opportunities out there. And if the thesis is buybacks and buyouts, that's not enough of the thesis for me.
So how long are we staying on this one for?
I think we're good.
You guys want to end it here? Everybody wants Chris to come on to talk about the thesis. I actually want to hear what he says.
We
Stay
can,
for,
or we
stay
can
for
invite
10
him
minutes and then
after.
we'll do after hours.
Okay, yeah, that's fine.
All right, Chris, I just sent you a link. We're going to stay for 10 minutes so you can share your thesis, and then we're going to go into the after hours. All right, he got the link.
Yeah. And yeah, like people are asking, is PayPal done for now? I mean, like, as far as the topic, Chris is going to want to talk some PayPal. Last time we tried to talk, I had internet issues yeah. So, but no, like as a company, they're not done. I think what's probably going to happen with PayPal, unless they're acquired, and there's a good chance that they are, that they're just going to kind of be on autopilot, which.
What companies would acquire them, though, do you think? And before you answer, the ones that come to my head, I feel like they would have acquired them at 50, like going to 40 doesn't change the valuation that much. That just made them mysteriously.
No, I don't think it's that, Steve. I think it's like when somebody signals interest, that's the trigger that gets other people interested. It's not the price being $10 higher.
That's why the rumors get floated, or at least part of the reason that they do is usually the party that's being bidded on is like, okay, this is happening. A, it gives some support to the stock price, and it certainly has. And B, you kind of signal to the market like, hey, these guys have a bid out there. Anyone else? Now,
yeah, but
the
then you
bad
wouldn't
news
deny it, right, Roy? Because PayPal said, no, we don't have any offers right now, right?
No, yeah, they do. It's very clear that they do. I think that they're credible as well. For buying all of PayPal, it's really just Stripe. JP Morgan Chase could. They have wanted to get into payments, but everybody else that would be interested in PayPal as a whole are just way too small. And but like parts of the business, like Braintree and Venmo in particular, there's a lot. Braintree, like if it, I guess to answer part of your question, Steve, in the past, part of the issue was regulators would stand in the way on almost everything. Like you even saw the Roombas or the robot vacuums not being able to be acquired by Amazon, which was the dumbest thing. So like if that didn't fly, there's no way that a lot of these companies would have ever acquired even part of PayPal. But now I think it's different. So Braintree probably still can't be acquired by Stripe simply because you just have the big three. This would consolidate them to the big two. But for there's a lot of other parties. So I think Google is an excellent candidate. They have a long working relationship with PayPal. They've done a lot with them, and they run Google Pay. Well, I mean, they're one of 3 payment service processors that operate Google Pay, and so they would actually benefit from having that, especially if it's not really that expensive and relative to what their cash flow is. Braintree is cheap for them. Apple, same thing. I don't know that Apple would do it, but Apple could do it, and of course. Payment service provider is something that they already use, which is third party. Braintree could be used and brought in for that solution as well. And there's a lot of other companies that are along that size that would benefit from it. Amazon, I don't know that they would move away from Adyen, which is mostly what they use for their white service payment service provider. But I mean, they could possibly want to acquire Braintree and use that to operate everything on their e-commerce side. Shopify would be another one. So there's a whole bunch out there, honestly. So I don't think they'll have a problem finding a credible buyer for Braintree, and that may have a significantly higher valuation, especially if a competitor is hearing, oh, my competition might buy these guys, we got to buy it, so we put a stop into it. But yeah, for the main business, I think there's just one buyer.
So, Chris, what's the thesis?
So, a couple of things. Did you guys ever watch the movie Moneyball?
Of course.
You know that scene where David Justice is acting like a complete dick, and
I'm not paying you for the player that you were. I'm paying you for the player that you are.
exactly. And that's the thing. Right now, people wanted to believe that David Justice was the same guy that you were buying, in the 90s when he was a rock star, right? And if you were paying at 70, 80, $90 a share for PayPal, then that's what you were paying for. You were paying for a growth company. At $40, you're paying basically for a value company, and which is what it is right now. Revenues are not growing nearly as big as they were in the past, and nor do I expect the revenues to go back into the double digits. Now, if that was the thesis, that'd be a whole different thing. But for me, I look at this from a value investor standpoint, where they're still generating almost $6 billion in free cash flow. They've got plenty of room to cut, to basically keep that cash flow going for a good amount of time. As for interested buyers, there's, of course, like you guys said, all of these guys that could buy them to integrate them into their ecosystem. But then there's also private equity that can come in. If you're talking about a company that's still generating $6 billion in free cash flow, that is a massive number. And especially if you compare it against a market cap, by the way, at $40, the market cap is $38 billion and zero net debt. So if they actually have more cash than they have debt. So it's not even like, hey, you're in a situation where this company is in distress, right? If you had a bunch of debt on the balance sheet and you also had declining revenues and declining growth, then you got a real problem on your hands. But they don't even have to worry really about the debt. They can handle the debt very easily. So in terms of a value investor, this company is not going bankrupt. That's number one. Number two, the buybacks that they actually guided for, they guided for $6 billion in buybacks for this year. So you kind of already know that, hey, they actually have a capital deployment strategy that's going to put basically a floor under the share price, right? So at $40, you're looking at literally a share buyback yield of about 17, 18%. Now, yes, I completely agree with you guys. Branded checkout is slowing down, and that's their higher margin business, right? So they get a take rate from branded checkout, which is every time you go to the website as PayPal, you click it, they get a cut from that. So that business is definitely on the material decline. But then you also have other parts of the business that are growing at a fast pace, like Venmo is growing. You've got Braintree, like you said, Roy. And then you also have this ads monetization program that's should be coming in slowly over the next 2-3 years. Now, what does that mean to me? That means that branded checkout, while it's in a declining standpoint, it's not like going away right away. It's going down at a very, very slow pace. The other guys are pushing up the operating income. They're becoming more profitable. So what you're likely to see is PayPal being able to maintain its current revenue model for at least the next 5-6 years. And if they can maintain the cash flow at the same time, you look at a company that can buy itself back. The other thing is there is huge amount of value in being having almost 450 million people as active users. They have monthly active users of 450 million people. That's 450 million eyeball pairs that are looking at this app. It's still one of the most popular apps on the Apple App Store. So the notion that this somehow is a dying business, yes, maybe the growth part of its phase is, no longer there. But dude, this is a mature business. If you give it a mature value and a mature multiple, this is actually not that bad of a buy. And especially if you keep your expectations measured, where you're not like, oh yeah, I need this thing to go to $500 in the next 2 years. You'll do fine on it. And especially if you know how to play the options game, that's another, way that you can actually outperform the market on this thing, because everyone has left it for dead. But the point that I'm trying to make here is that if your expectation is, hey, I need to make that quick 100% return, which is what's like, the flavor of day in this market right now, where it's like, oh my God, my stock hasn't moved 10% in less than 6 months. Like, no, that's where you're probably not going to want to buy PayPal. But if you're willing to get that nice 10, 15% compounded annual growth for the next 5, 10, 15 years, that's a pretty good value right now. And like I said, with the current share buybacks, you're looking at about a 17% buyback yield, which means that whatever guidance that they gave was before all of this stuff. So it'll be curious to see in the next couple of quarters what the how much of their float that they've been able to successfully buy back. And if, especially right now at 38.40, if they were able to front load any of it. Now, the other thing is the incentive structure for the new CEO that's coming in is all about share price appreciation. His compensation package is based on share price appreciation, where they take the last 30 days of him taking over on March 1st, using that as the weighted average share price. And then from there, he has to grow the share price 60% in the next 3 years in order to get the first part of his tranche, his bonus. This guy, if you look at his MO from HP, where he was before, he's all about unlocking shareholder value, not growing the company. All right. He's not going to do that. But for me, as an investor and someone who's more of a quick hitter than trying to buy this and put it in a long-term portfolio, I know that this company has the ability to get back to that $60 amount in the next at least, 6 to 9 months, maybe a little bit longer. And if you think about it, my entry price is about 38, 39. So you're looking at a 50% return, which is fine by me. Yeah, I'm not going to become, the next Palantir millionaire, but I'm okay with getting a 50% return. And then if you use some options, you leverage it, you could probably get, I'm actually up almost like 40% on the position now because I know what to do. But the point is, I think people need to, in this market, understand that not everything is a growth company that's worth investing in. If it's not growing, I'm not buying. Okay, if that's the kind of investor you are, by all means, just find those companies that you want to, touch on. But sometimes value investors, they do make money too. And right now, as a value investor, I see the value in this company.
Are you playing it just with shares, Chris, or you said options as well? Like, are
No,
you
no,
doing
I'm playing it straight up options, man. The options market's cheap right now. Everyone discounted this thing. I was able to buy the spreads at a very discounted price, and now they're slowly going up. The buyout news did have a little bit of a negative impact because some of my strikes were really far out of the money. Like I had $90 strikes that I used to subsidize my near-term strikes. So when the buyout news came, what happens is if someone says we're going to buy you out, all of a sudden now all that time value that people paid for that $90 call, it literally collapsed on itself. So it literally dropped almost 40%. What did I do? I took profit. I bought it back and I sold to 70. And now that the buy off rumor is, gone, now all of a sudden that $90 call option went up. Like, even though the stock went down from the news, like, hey, listen, we're not going to get bought out. The $90 call option went back up because that time premium, like, was basically restored to it. Right. So right now, I think PayPal is in a position where I don't think this company, if this company was $60, I would not touch it. I'll be honest. Like when you guys were talking about it for the last 2 years at 55, 60, I was like, you know what? I don't see the growth. I really don't. I wouldn't touch it. But at $40, 38, I mean, this is like pure value here. It's like literally that's a 50% upside from here, which is fine by me, even if it takes a year, 2 years, 3 years. That means that, let's say I bought SoFi at $20. That means I would need SoFi to get to 30 before I made the same amount of return. So when I look at this, I'm looking at a more guaranteed situation with PayPal, where I know that because the share price is low, they can buy back shares at a really, really discounted price, which means that their EPS will keep growing. Now the thing that would be a thesis breaker for me, Roy, and I hope you guys realize it, is if their free cash flow starts dipping and goes into like 6 billion to 5 billion to 4 billion, then it's like, yeah, I'm good. I don't want to be in this anymore, because I know that the free cash flow can't support the buybacks anymore. But if they can maintain that free cash flow, whether that's through, organic growth, through some cost cutting here and there, and they can do it for the next 3, 4, 5 years, whatever, totally fine with it.
Yeah, unless the some of the new projects start working and driving volume, I think that you will see the free cash flow shrink some.
Yeah,
it's not going to fall off a cliff, but yeah.
Yeah, I mean, it's a melting ice cube, right? But once again, it's like the David Justice thing. I'm not trying to buy you for the player you are. I mean, you were. I'm trying to buy you for the player you are right now. So this is classic Moneyball. When something gets super oversold, but it's a business that still has juice in it, and it could keep juicing for the next. I'm looking for David Justice to keep hitting singles. That is what I'm trying to have PayPal do right now. And if I can make money on it, by all means. And I'm notoriously a mercenary. I'm not like these guys, like in the chat, like Roy Tevis, They develop hardcore great theses on businesses. I'm looking at purely the numbers on this thing, and the numbers just seem very attractive to me. So I'm not trying to look at the personalities of like the executives that are coming in and seeing what's there. I'm just purely looking at what is the incentive structure for leadership here? What's the incentive structure for shareholders? And is it worth putting some money towards it? Because it's like, okay, it stays at $45 for a year. Calculate the amount of share buybacks they do. Now you got yourself a float that gets reduced by about 15%, right? Which is crazy. And then the year after that, if it stays another $45, it gets reduced by another 15%. That means like 30% of the float will be gone in literally 2 years, which is amazing if you think about it from a shareholder value perspective. So once again, the thesis here is it's a slow melting ice cube. The people that thought this was a growth company and gave it a growth multiple, I'm sorry, you got sold, you got sold the wrong idea. But now it's deep value, and deep value is a place that you could make some money as long as you're being strategic. You're monitoring this. This is not one of those companies that you want to buy into a portfolio and hold it for the next 20 years. All right. This is like you buy it, it goes up, it gets to your target range, you sell it and make a good return, and you recycle the money somewhere else.
All right. Well, I hope it works out for you and other shareholders. I don't think I think the worst case scenario that you're looking at from here is opportunity cost. So like you said, it's not the most exciting business, not the most exciting leadership, lots of issues, but it is worth something. So
Yeah, exactly.
and there are a number of catalysts that can give you that upside that you talked about. But yeah, for me, there's better place.
Yeah. Like I said, each this is where, from an investing standpoint, everyone's going to have different perspectives on how they make money. And me, I'm more of a mercenary. I go in a position because it's value, and then I get out of the position when it's no longer value. Like, I'll tell you, one of my biggest wins over the last couple of years has been Truist. Right, the thing dropped down to $28. Normally, I would never buy a bank. I don't really care about banks, to be honest with you guys. Banks are not my cup of tea. But when I saw tangible book value on Truist, which is one of the largest regional banks down here, go to like 60 cents on the dollar, it was like, wait a second, what am I not seeing here? Like, they don't have nearly the amount of commercial exposure to everyone else, right? Was able to buy it, used it with leverage with the options, and did particularly well on it. And that's the key with a lot of these cyclical businesses, by the way, guys. And this is something that I told Amit, and I was trying to tell people in his chat. I was like, if you have a business that is a cyclical business, people are going to give it a much lower multiple. So if you see a business like a bank and it's trading at a 30 PE, just know that that's probably the type of the top of the cycle. And the behavior from there typically goes in the other direction, where most of the time the banks sit around that 10 PE, 12 PE range. So if you see a bank trading at like a 5 PE with tangible book discounted relative to fair value, right? Like tangible book in the like a 30-40% discount, dude, that's a perfect entry. A lot of people said the same thing about Verizon. Verizon was in the same boat. You saw the company, yeah, it's not growing like double digits, but dude, they're generating meaningful cash flows that they're utilizing to do dividends. And then also now they're doing buybacks. So, and they're deleveraging, which is another thing. So I would say, look at some of the unsexy parts of the markets too, guys. Like, I feel like you guys tend to look at the sexy parts of the market. Look at the unsexy stuff. That's what me and Steve do. We look at the grimy shit. The grimy shit is good stuff.
I mean, Chris calls me up today and he says, I think we should start looking at BDCs. I'm like, Ares Capital is the gold standard. He's like, that's the one I was looking at. Grimy shit.
Yeah, sometimes there's a lot of gold that, here's an example of something you could make money off. You could make money off of going to Alaska and just, like there were previously gold mining operations where they had all these tailings, but they didn't have good technology back then to extract all the tailings. Bro, go ahead, buy those tailings. You could and use newer process, extract the gold from that. So other people consider that shit. I'm like, wait a second, no, with new technology, you could do really well. So there's so many businesses right now that are in this position where people have kind of just left them for dead. But if you understand the capital markets, you understand what the true value of a company is going to be, just based on just the pure numbers, you could theoretically make some money. Like Fiserv right now. I know a lot of people, they don't care about Fiserv. They don't know. They're like, oh, Fiserv, aren't they like the dinosaur legacy? Like,
I'd rather own Fiserv than PayPal if I had to.
Say that again. Sorry.
I'd rather own Fiserv than PayPal if I had to, although the debt is concerning. But
yeah, I mean, that's the other thing too. Like when you have a company like Fiserv, yeah, they have a lot of debt, but they have more, more regular cash flows. They've got businesses that are, pretty much tied into their ecosystem. So every one of them, you have to do like an individual analysis. But the point that I'm trying to say is, in this market, I think it's not a bad idea to go dumpster diving. Like there's a lot of great companies that have been sold off. And yes, they may not be growing at the double digits. They may not have the newest sexy AI product, but dude, they generate cash flow. And at the end of the day, that's all that matters to me as a shareholder. Cash flow, cash flow, cash flow.
Yeah, I mean, I share the sentiment at the current price. Tevis, Roy, anything else?
Nothing on my end.
no, that's more PayPal than I wanted to discuss. So I'm good.
I think the best comment so far in the chat: ugly chicks need love too. What? Leave me alone. I'm talking to my boys. Sorry, I'm in bed with the wife. I'll talk to you guys later. Have a good one.
Later, Chris.
Later. All right, you want to move to after hours, guys?
Let's do it.
All right, I sent the link in the private chat. Everybody, thank you for joining. We will be moving to the after hours in about 5 minutes. If you are a member of Tevis, Roy, or my channel, you can catch it live in 5 minutes. Thank you, everybody, for being here. We greatly appreciate it, and we'll see you next week.